Hello traders, this is Chris Buss with Traders Profit Compass with your Weekend Profit Navigator for Sunday, October 4th. Okay, what I want to do today is first off we're going to look at some risk on, risk off indicators that I like to keep an eye on. Then we're going to move into the US dollar in relation to gold and silver. We'll cover off the indexes on the weekly and daily time frames. Then move into FANG, the energy complex, and then a couple ETFs that look promising for bullish trades into next week. So let's get into it. The first chart here is a daily chart of transports against utilities. And when this chart is rising, it's bullish, and when it's falling, it's bearish. So here we've got a nice rising trend off the March lows. And now we've had the initial move of a trend line break and testing this support level. So this is something to watch going forward. Bulls certainly don't want to see this break because that would mean utilities are outperforming transports, and transports have been a very strong sector. So right now we're on yellow flag status with this trend break. What would turn it more bearish would be, of course, a breakdown below this level here, this 1330 level, losing this support and then coming down. But when we go to look at other risk on, risk off metrics, this is high beta versus low vol. Again, a rising ratio is bullish. You can see that we've settled into this trading range. We've tested support here a few times and it has held. But if this were to break down, lose the 200 and then move lower, that would be telling us we're moving into a risk-off environment. Same thing here, consumer discretionary versus staples. No problem whatsoever here. As we see, the ratio in general is rising. We've got this consolidation area towards the top. So as this stands now, still says risk on. What would change that, of course, if this rolls over and starts coming down. But right now, no signs of that whatsoever. Same thing with semiconductors versus SPY. We've got a nice uptrend channel working with the ratio right in the middle of the range. So no signs or cracks of trouble here. What would change that is, of course, dropping out of this channel and then moving below, with semiconductors starting to underperform SPY. So 3 of the 4 charts that I just showed you are maintaining the status quo, which is a bullish posture, with the transports and utilities being the only one that's really starting to show signs of an issue. So we'll keep an eye on that in the weeks ahead and look for signs of either strengthening, weakening, or just maintaining the status quo. Moving on to the euro, I've been really focused in on the dollar and the gold and silver trade the last several weeks. We had honed in on the euro US dollar pair, the euro being, as you'll recall, about 63% of the dollar index. So euro strength basically means US dollar weakness. And we can see this big move off of support up here. That's been the short dollar trade, long euro trade. It hit this wall of downtrend resistance, consolidated for quite a number of weeks, and then has since broken below. And you can see here a back test of broken support which became resistance and is now starting to roll over. So that's a common technical move. We see that all the time in equities and really anything that we chart. Oftentimes, once you get a breakdown, price revisits the scene of the crime, the location of the breakdown for a double check, and then moves away. We see that also on the other side where price will break out, back test the breakout, and then go. So here I'm looking for a continued move lower down towards this 115, 114.50 area in the euro. And if we look at the US dollar chart, we see the same thing in reverse. We had this rounding bottom and a breakout above 93.70, let's call it. We broke out, and then this past week, we've come back to back test that breakout. That's a common move, the one we just talked about. So for this week, what's going to be really important is for the dollar to hold its breakout and go higher. That's my base case. That's what I'm expecting. If price were to move down below support, below 93.50, then that would make this move look suspect. False breakout. Now remember that the short dollar trade remains very crowded. Everybody and their brother are still expecting the dollar to fall and are short the dollar. So from a sentiment perspective, that's contrarian bullish. And what I expect to see is with the back test complete, I expect the dollar to move higher. I expect the crowded short dollar trade to unwind, which will of course be more fuel for a higher move in the dollar. And my target, first target, is up here to test the 200 around 96. So we're sitting at 93.71, so that would give it a good, 2 cents, 3 cents higher up here towards 96. And that would be a headwind for the precious metals. Let's take a look at it. This was the initial move of the dollar going higher, where we saw gold sell off. This was the head fake that we sidestepped. We decided not to take that long. We sidestepped that. And then gold broke below this key level of 180. And here is the last week of trading, where the dollar was coming back to back test its breakout. With the dollar falling, gold was rising. But now we've got, if I've counted them correctly, 4 layers of resistance. We've got the downtrend line. That's one. We've got overhead resistance at 180 with all these trades. That's broken support becomes resistance. So now that's another layer. And we've got a declining 20 EMA and a declining 50 EMA between price and the breakout. So in order for gold to move above 180, it's got to take out the 50 EMA, the 20 EMA, 180 lateral overhead resistance, and the downtrend line. And my base case is it can't do it. I think the dollar makes a move back higher. I think gold has trouble here, and I think it moves down towards 170. Now for trading, resistance is resistance until broken. I think this sets up as a low risk short. What do I mean by that? Get short against 180 with a stop just above, and look for a move towards 171. So you got $8 or $9 of potential downside against $1 or $2 of risk, depending on how tight you want to put your stop. I think that's a great risk reward trade, and you'll know immediately if you're wrong. With a move above 180, you just take it off. And even at that point, if the dollar starts falling, get long, because there's a gap to fill above, and then with all this resistance taken out, that'll all become support. So we're at a critical point on the gold chart, and I think it's all going to link back to the euro and the US dollar. Let's look at silver. Pretty much the same thing. It's not as tight a setup as gold because it's still a little bit below this level of 23, which is key resistance. But the same idea holds. You've got a declining 20, you've got a declining 50, and you've got lateral resistance at 23. If you got a pop tomorrow a little bit higher, up towards 23, I think that's your spot where you hit it short and you set your stop just above, and then look for a move back down towards this 2050 area. I think that sets up as a nice short as well. You can see here that RSI has moved into bearish territory, as has momentum. I think it would take a lot to have silver just take out this 23 and go. I think it comes back down for another check of this low at a minimum, possibly even down towards this 19 or 1750 if the dollar really picks up steam. But that's all down the road. Right now, the critical spot on your chart is 23. Above is bullish, below is bearish. Okay, let's move on to the indexes. This is the SPY weekly chart, and we had pointed out in the last couple of weeks that when you get these high-level PPO crosses on the weekly chart, it usually foretells that a down move is coming. See that here. Now, this past week, we see that the momentum is definitely rolling over, but we haven't got that bear cross yet. So there's still time to save it. But once this thing rolls over, if it does, and you see momentum starting to go bearish, you need to be concerned from a longer term perspective, because once these things roll over, they usually don't turn on a dime. And what I mean by that is reverse right away with a false signal. It happens, but not very often. So we need to be aware of the posture of this momentum on the weekly. We can see here that RSI has already broken trend. So a couple of the pieces are falling into place, but any up move next week, and then this will, they call it a bull kiss, where it comes down and touches but never crosses and then moves back up. That's certainly a possibility. When we go down to the daily chart, we have been in a battle for several weeks in this 341 to 320 trading area. We broke down, we dropped out of the channel. We made a couple runs at 341.50, was rejected, went to the bottom of the box, spent several days down at the bottom, down at 322, 320. Then we went back up to the top of the box where we were this week, where that level was again rejected. You can see here that price is again sitting on the 50 EMA in green. So as long as it holds the 50, there's a chance of coming back up to test the top of this range at 341.50. But if it drops below, then it would be favored to come back down towards the bottom of the box, towards 320, 322, and test that low. Within the range, you're just trading volatility. There's no direct, big directional bias. So you've got to be really careful, getting gonzo long or gonzo short, because as soon as you get the position on, then it reverses, because there's no directional bias inside these trading ranges. I mean, that's why they call it a trading range. For a more confident positioning, you've got to wait for either a breakout or a breakdown, or if your bias is short, you can short against the top of the box and look for a move to the bottom where you would cover, and vice versa. Getting long here at the bottom was a great trade, looking for a move back up to the top of the box. That's intraday, short-term type trading. That's a hard swing trade to make just because of the volatility. You get on, you hold overnight, and then they reverse it overnight. So that can be really frustrating. But from a tactical perspective, you want to sell resistance and buy support. And that'll keep working until it doesn't. So in the days ahead, if price were to break out above 341.50, you would have a much more confident long bias where you could set your stop just below and then stay long above. And on the flip side, if we were to break down below 320, then you could get short with a stop just above and look for lower prices. But as long as price stays in here, it's just a lot of volatility, a lot of chop, a lot of headline risk. Stimulus is on, stimulus is off. Trump's getting better, Trump's getting worse. All that kind of stuff is going to move the intraday, prices. So you've got to be really nimble if you're in, when you're in this range. And of course, that's going to affect all your individual names as well. Very much the same idea on QQQ. Oh, I had these backwards. Let me switch that. Let's look at the weekly first. Same idea. High level weekly bear crosses on PPO. We got one here. They usually don't end well. Even here on this shallow cross, you can see that there was a decent pullback to the 40-week EMA. Here in March, it was a lot more dramatic. Here, things are just getting started. We had the initial sell-off, and now we've had 2 weeks of higher prices, but all things considered, not a really strong bounce. So we've got an RSI sell signal on the break of trend. We've got a PPO sell signal on the bear cross. We've got a price sell signal on the break of trend. So we've got 3 levels of sell signals all confirming each other: RSI, PPO, and price. So there has to be a lot of caution there. If you are bullishly positioned from a longer term perspective on the weekly chart, this says to either step aside or have a short bias. That's what all this says. And if we were to take out the lows, which is down here at 260, then your first move is going to be to the 40-week EMA at 241, and then possibly a back test of this 235, which was the February high. From a technical standpoint, that's a common move, to have a breakout and then a back test, and then all those things considered, then it could go. I mean, that's basically a 50% halfback Fibonacci. Still, the longer term uptrend would be intact. So that doesn't necessarily mean the bull run is over. We're just in a corrective phase right now where, all things considered, lower prices would be favored from here versus higher prices. So let's look at the chart on the daily. Just like SPY, we're in the chop zone. We have a high at 280, and we've got a low which was tested twice right around 260, 262, down in that area. And now we're at the high end of the range after a baby fake breakout. You'll recall that we got up into the 283s, which was never confirmed by SPY. SPY did not break out, wasn't even close. And then on Friday, they sold it pretty good, off about 3% on a lot of names. But still above the 50 here in green. So we're in the upper half of the trading range. A break below the 50 would favor a move back down towards the bottom of the box. So, just like we said before, if you're interested in trading the trading range, you're selling resistance at 280, you're covering at 260, and then you're going long for a move back up to the top of the box. And that'll continue to work until it doesn't, until we have either a breakout or a breakdown. And then when that happens, you have a much better opportunity for a trade with more duration. Once this breaks down, this is basically a $20 trading range. If we were to break out above 280, your measured move would be 300. And on the downside, a break below 260 would target 240 and a tag of the 200. So that's it. Breakouts bullish, breakdowns bearish. In between is a lot of volatility and a lot of chop. If you're nimble, you can make a lot of money in here, and some in the group have. But if that's not your thing, I think you got to wait. You got to wait to see that decisive move, either higher or lower out of this range. IWM has been lagging in general. It's not, it never even came back up close to the February highs. We've had this bounce, came up into this 157.50 area, was rejected, bounced again off this 142.50 area, and had a nice week this past week as money found its way back into cyclicals and industrials and beaten down names on the back to normal trade. So going forward, for me, I want to see price take out this downtrend resistance right here and break above 157. I don't want to be the guy down here, trying to get the drop on everybody and jumping into that cyclical back to normal trade, because recently it's been a widowmaker. Anybody that has jumped in on the, trying to get that move, very shortly afterward, they've gotten their head handed to them when they reverse it. So I would rather wait to see if price can truly break out above these overhead resistance levels. And if it can, if price can break above 157.50, then it's got a pretty clean shot to get back up to the highs, 167.50. And that's, that's a $10 move. That's a good trade. But down here, I think there's too much risk to try and, game this few dollars down here. I think there's a good chance that with SPY and QQQ towards the top of their range, if they roll over, it's going to be difficult for IWM to continue to outperform and just power higher in all those cyclical, I'll call them junk names that have been beaten up. I think they're going to have a hard time actually powering through that. Here you can see it on the daily chart with I've penciled in a downtrend line here. If you were nimble and you wanted to give that a try, if price can pop above that downtrend resistance, you could possibly see a move up to 160. So that gives you a $5, a $5 trade. Catch it here at 155. See if you can get a move up to 160. If I saw that intraday, I might be tempted to, take that on an intraday trade. But I don't want to camp out with some big swing trade trying to capture that. If it were to break above, then that's going to be off to the races. If it could take out, this 160 level, which was tested twice here in that trading range, then it's got legs. So just to sum up the indexes, SPY and QQQ are definitely in trading ranges, and wide trading ranges at that. Expect a lot of volatility this week. A lot of headline risk. I don't think it's a time to be piling in either long or short. There's no great bias in either direction while it's inside the range. I think if you're a nimble trader, you can make some good money if you're agile like that inside the range. But other than that, I think it's a time to be cautious and waiting for those trading ranges to resolve. Let's go ahead and run through the FANG names. Starting with Facebook, we had the big move down and we tested this big gap below, which held on its initial tag. Came back to back test it once and have put in, to me, what looks like a potential bear flag. Now, if this bear flag, if that's truly what it is, breaks this week, then that measured move is quite substantial. It would have price coming down towards this 249, 248 area where the gap is, filling that gap, and then retesting the original breakout, which was at 221.71. Symmetrically, it looks elegant. A measured move halfway, and then the completed move coming back to back test the original breakout. If we look at RSI, it's in bearish territory below 50, came down, did a little back test of this trend, and then moved down on Friday. Momentum has gone bearish after being bullish all this time. So now it's below zero, made a very weak bounce, and looks like it's poised to roll over. And remember what we said, a bearish crossover just below the zero line is often a very, very bearish move. We'll wait to see if that happens this week. But if it does, and you see this roll over, and you see price lose this bear flag, then I think you're going to see moves back to test this gap. And if it enters the gap this time, I don't think they can save it. I think it'll come down here to this 235 area where there's the potential for a bounce. But ultimately, if this picks up a head of steam, I think you'll see a test of the 200 and possibly a test of the original breakout at 221. I haven't drawn it in as well as I did on Facebook, but Apple has the same kind of look. We had an initial move down. This is that big void in the charts that we've noted, with only 1 day's trading between 96 and 108. So there's a big open void in this area. Price has bounced, came back to this 118 this week, where it ran into a wall and then rolled over. So now we've got the 50 just below, and then this gap area support down at 108. RSI is weak, back below 50. Momentum is very weak here as well. You can see where it tried to make an upswing and then has since started to flatten out. If you see momentum roll over, you see price lose the 50, and then you see price lose this 108 area, I think that's your short trigger. I think this time around, if you get that move, then I think price will come down and work on filling this gap down to around 96. Now, on the flip side of that, if we see price hold the 50 and make a move back up, that would be a bullish sign. But in terms of a longer trade, I think you've got to take out this 123 area. I think that's where it is on the shorter time frame charts. I think there's a level at 123 where it had trouble. But if it broke above that, then you could get long against that level and look for a push higher back towards to retest this prior high at 136 or whatever it was, 138. But I don't think that's going to happen. I think they're using these big FANG names as a source of funds to book profits, to put them into some of these fresh IPOs, into cyclical beaten up names. And I think this mega cap tech trade is starting to wane. And what I think is going to happen, if that thesis is correct, I think you'll see it hit all of them. It's not just going to be, oh, well, Facebook broke down and the others are fine. I think you'll see that breakdown. If it's going to happen, I think you're going to see it across the board. Here in Amazon, same kind of look. First move down to this key 2950 area. Got a bounce. Back check of resistance. You know, the scene of the crime. Make a move down. Come back for a back test. And then start to roll over. We see it here in RSI, same kind of look. Down move, back up to 50 and start to roll over. Momentum does not get above the zero line, starts to flatten below zero, and looks like it may be starting to flatten out here and potentially roll over. If you saw the flag break down in the days ahead, and it's going to happen this week, I would think, if it's going to. You know, if it stays up here, it's not really going to have that bear flag look. And of course, if it breaks out, then the whole idea is wrong. But if you see that breakdown this week, I think you're going to see a fast move towards 2950. And then if that level were to break, coming down towards 2800 or even a little bit lower. But I think the posture here is bearish. The only thing that would make it bullish is breaking back above 3250. That would take a lot of the bearish look of this chart and negate it. Microsoft, same kind of idea. Breakdown, back test fail, move down. This 202.50 area has seen a lot of traffic. You can see the large volume over price bars here. A lot of transactions, a lot of price discovery in this area. If it were to lose 202.50, then we'll come back down to retest the lows at 195, 196, and then if that doesn't hold, we back test the original breakout at 190 with the 200 just below at 185, and I think you'd see a lot of dipsters right there on the back test of that breakout with the 200 below. That would be a logical spot to try a long. And then, you know, if the 200 didn't hold, we'll have bigger fish to fry. if these big names can't hold their 200, then you're looking at a much more pronounced pullback. But just keep in mind, a back test of the breakout is a common technical move, and the bullish trend would still be intact from a longer term perspective. So this isn't the sky is falling. It's just this is in a bearish technical setup short term. And that's all it is. Netflix had a really good week, coming off of this support here at 470 that has been tested multiple times. You can see it was resistance until it broke out. Back test, bounce, back test, bounce, big move, double top, coming back to 470, another big bounce that looked like it got rejected on Friday. If price were to break out above Thursday's high, right here at, I think it was 525-ish, you can take it long and then look for a move back up towards 550. But unless price can do that, I think it's going to come back towards this 470 over time. And then that'll be the real moment of truth. If you go down to a 30-minute chart, you can see there's a lot of intermediate levels here. I know 505 is one. I know 495 is one. And I know 480 is a level on a shorter term time frame. This has been trading really, really well on those short time frame charts to the technicals. So from a longer term perspective, Netflix has to hold 470 or it's coming back down for a test of the 200 at 440 and a potential test here at 415 where there's a lot of technical support. So you can see RSI is still above 50 and PPO has a much stronger profile than some of the other names we just looked at. If this can make a push above the zero line and RSI can break out above this downtrend line, likely you'll see a breakout here above downtrend resistance. But my base case is it comes back to 470 for yet another test of that level. Google has been weaker than most. Bearish posture on the RSI, bearish posture on the PPO, big move down, very weak bounce, and very close already to the 200. Trading Google is not really my thing, but right now, if you were long, I'd be focused in on the 200. It's got to hold. If it doesn't hold the 200, just on a measured move basis, you're looking at a pretty deep pullback in towards 1300 or even 1250. And from a FANG sentiment standpoint, you don't want to see these big names start losing the 200, and Google is the closest to it of the names in the the index. So watch the 200 on Google. That may be worth an alarm for you, even if you're not trading it. If things are still relatively bullish, that should hold. It held the first time. You'd want it to hold the second time. And if it doesn't, then, you could take a longer term duration trade against the 200 for a deeper pullback. And that would be a very objective, low risk trade. I mean, you set a $10 stop above the 200, and then you look for, 100, 150, $200 move lower. Tesla has held up better than most. It's got this little triangle working here. I think it's, on the daily time frame, it's going to be tough to trade while it's in this triangle. I would be looking for either a breakout or a breakdown. You can see the 50, the green line here, converging with this uptrend line. I think that's the area that it's got to hold, and it has so far. We had a 50 EMA test right here, got a nice bounce off of it, but for a longer term trade, into the weeks, not hours or days, you want to see a breakout above 450 or a breakdown below the 50 EMA for a more longer lasting duration type trade. Okay, summarizing the FANG names, to me, aside from Tesla, they look pretty weak. I stand by what I think is happening, that people are starting to book their profits. Shoot now and ask questions later kind of thing. And think about, try to get into the sentiment. If Biden wins, big chance that capital gains taxes are going up. So if you've been riding this thing forever and you've got massive embedded gains, do you want to wait until everybody and their brother figures out that, that Biden won and capital gains are going up, the first part of next year, and everybody starts selling into the new year? Or do you want to do that now and rotate your money into something that might be more productive? That's just one scenario, but you can't deny that the posture of these market leading names is bearish. Whether it resolves bearishly, that's yet to be seen. So, and that's going to weigh, if it does play out that way, that's going to weigh on SPY and, of course, QQQ. So even though, cruise lines and restaurants and travel stocks might be going up on the back to normal trade, that's not going to help the indexes. They just don't have the horsepower or the market cap to keep the big indexes afloat if these bigger names are going to sell off. Let's move into some different territory. I think during one of the recent daily notes, I made note of oil. This is USO. This is the tradable ETF for crude oil. I made note of this big $3 void between 26 and 23 that I suggested that you alarm. And I still suggest that you alarm, because now we're testing it. Crude was off 4% on Friday. Big move down. So whether it finds its support right here and puts in a bounce remains to be seen. But if it doesn't, if it breaks below, then there's not a lot stopping it for, a flash move lower. You can see that price is below all the fast moving averages. Here's the 50, the 20, and the 8. The 200 is way up here. So very bearish posture, but price is at support, and support is support until it's broken. One thing I thought was really interesting, though, and a couple people pointed this out, is this is the ETF for the exploration and production companies, XOP. So oil was down 4% and XOP was up 2%. That's a dramatic divergence. And one day doesn't make a trend, one day doesn't make a reversal. But I thought that was really interesting. So for those interested in possibly trading this, I would do two things. I would put an alarm at, say, 42.50 or 43 for a potential topside breakout. And I'd put one right here at 38.50. I would go down to a shorter term time frame to get that exact. But just at the, well, I can get it here, the low of the day. 39.15 was the low. You can set your alarm at 39. If 39 breaks, I think you can be short against it and look for the March lows. If the bulls have said, you know what, enough is enough, these are too cheap, and they pop it above 43, I think you could see a move back up towards 48, 50 possibly even 57 if there's some renaissance in energy. I wouldn't go long here. There's just too much overhead resistance, and this could have been, short covering, not necessarily, new interested buyers down here. So I went through and looked at a lot of energy stocks over the last week, majors, refiners, all that kind of stuff, explorers. A lot of them are already near their March lows. So depending on the kind of trader you are, of, whether you want to buy support for those stocks that are already at or near the, their March lows, might see a double bottom there. I'm not prepared to say that or even tell you that's what I think is going to happen. But if you're interested in energy, there may be some interesting setups in the days and weeks ahead, depending on how, what oil does and the rest of the market. So I thought that was interesting. Also, XLE, we had this trade pretty well nailed. We were looking for breakdowns of, 34 and then 32, and we got that. But again, oil was down 4% and XLE was up 1% off of this low at 28. Set yourself an alarm there. If it breaks down, probably not a ton to stop it until it goes back to tag these March lows. On the upside, this is too early for me. I want to see all this stuff recaptured. I want to see 32 recaptured. I want to see the downtrend resistance taken out, or else it actually sets up as a back test and then a reshort. Remember, overhead resistance is resistance until it's taken out. So I don't like to take longs when they're below resistance. I would rather buy it once that level has been recaptured than trying to, get cute down in this area, thinking that I've caught some kind of big reversal. I would rather wait and then pick it up later on after price has proven that it's got some momentum behind it, and energy is about the farthest thing from what you'd call having positive momentum. A couple of ETFs that I think look pretty interesting on the long side. First one is the Home Builders, ITB. It had several weeks of gentle correction, and now it has broken out on Friday above this 57 level. And you can see that price is above all the moving averages. PPO is pulled into the zero line and now it's turned up. And RSI has broken downtrend resistance as well. That looks like a nice long to me. All-time highs are bullish. So if you wanted to take a long against 57 with a stop just below, I think that might be a really nice trade. And I would go out farther in time. I would go out to December or even January with the idea that whenever it comes, whoever wins, that there'll be a stimulus package which will be net bullish for the market, and with price breaking out to all-time highs, I think it sets up as a good risk reward. If you set your stop at the bottom of this candle, 57.76 down here, then you can stay long against that level and maybe get a push into the new year with Home Builders staying strong. Another ETF is XHB. Has the same look and feel, breaking out to new highs. The main difference is XHB is going to have your home you're going to have your Home Depots and Lowe's in there. ITB is Home Builders without the extra stuff. So this is more of a pure play on Home Builders, where XHB has Home Builders and home improvement centers and stuff like that in it. So it just depends on how you want to play that. Another chart that I think looks bullish is the equal weighted XRT retail ETF. We had a gentle pullback to the 50, but now price has broken above all the moving averages, has taken out downtrend resistance. So I think this sets up as a long, looking for, at a minimum, a move to 53, which was the prior high, and I'd be looking for a breakout there to take it higher. Again, a stimulus package heading into the Christmas holidays. I think retail will do fine. But that's more of a macro comment. Just from the technicals, I think you can stay long against 50, and with these fast moving averages starting to curl up, those are going to be support on the way back up again. So I think from a technical standpoint, I think this sets up as a nice long. Okay, that's all I have for you. Let's do a quick recap. Risk on, risk off. One or two yellow flags, but nothing dire. The risk on, risk off measures still say have a bullish bias. US dollar. I'm looking for strength in the dollar this week and for gold and silver to roll over. I think gold sets up as a low risk short with a short against 180 with a stop just below, or excuse me, just above, and looking for a move back towards 170. Silver, 23 is your line. I think you can short against 23 with a stop just above and looking for a move back down towards 21 to 2050 to backtest that prior low. Indexes. SPY and QQQ are in very wide trading ranges. I think the order of the day is trade small, if at all. I don't think it's an environment to pile in long or pile in short. There's going to be a lot of headline risk between now and the election, and probably even more so in the next couple weeks as, you know, the president faces his, you know, health concerns. Be ready for whipsaws. You know, he's getting better, he's getting worse. You know, Steve Mnuchin tested positive or whatever, you know, news might come out of DC as far as the health goes. I'm not expecting a relief package, you know, in the next 2 weeks. I just don't, I can't see that. But if it did happen, that's going to be market positive. But there's going to be a lot of headline risk. Trade small, if at all. Stay nimble, stay tactical. Wait for breakouts or breakdowns from those big trading ranges before you decide to, you know, go gonzo either long or short based on that breakout. IWM, let's see if this rotation into cyclicals and back to normal trade has legs. We've seen it. We've seen this movie before, you know, 3 days and then they pull the rug. So looks promising as it has before, but I want to see follow through. FANG names. I think they're being used as an ATM. I think people are concluding the risk is to the downside. So they're taking their money now. And if they can prove that they can reaccelerate, they'll come back in. But I think right now, based on the charts, it tells me money is coming out of that sector. And if those bear flags that I penciled in play out, we have lower to fall. And if we fall lower, just because of the market cap involved, QQQ and SPY are going to follow. There's not enough horsepower in the smaller names to keep those indexes higher into in the face of the mega cap tech names selling off. So stay abreast of that. Energy looks interesting. Watch for USO. It's at support. Any failure from here, you could see a flush in crude oil, and then we'll have to see how that affects energy shares. There could be potential trades there, either going higher or lower. I gave you the critical levels. And then 2 long ideas on the home builders, ITB, or XHB if you prefer, and XRT. Both have good looking technicals, good looking price patterns. I think they offer a good risk reward to be long those. Looking farther out into the year, either into December or January, I think those sectors have a good chance of performing well. I hope you found the information useful. If you did, please hit the like button. I'd really appreciate that. And if you're new to the channel, Please subscribe and hit the alarm bell, and you'll get notified when I publish new content. Check out the show notes where you'll see links to the blog and to register for all my content to be delivered directly to your mailbox. That would be awesome if you chose to do that. I do my best to keep you updated on timely information to the markets that'll be actionable for you to, with ideas that you can take in your own trading. So I really appreciate your time this afternoon. I hope you have a good rest of the weekend, and we'll hit it again tomorrow, bright and early, as we always do. This has been Chris Buss with Trader's Profit Compass. Talk to you next time.